Hello and a warm welcome to Econoday Unplugged on Tuesday, the 1st of June, already 2021. Mark Penders stateside. I'm Jeremy Hawkins in London. It's a busy period for economic news, which includes a number of GDP, inflation, labour market and PMI updates from around the world, as well as central bank announcements from reserve banks of Australia and India. However, despite the current slightly more relaxed feel to the bond markets, input costs are on the rise pretty well everywhere. So it's likely to be Friday's US employment data that had the greatest potential to sway investor sentiment. So best we start there then. So straight across to Mark, what's expected and what particular aspects should we be focused on?
Well, the economy consensus for non-farm payroll growth is 645,000 for May. The consensus range is from 400,000 to 950,000. So there's a possibility we could get 1 million on the payrolls, but listeners beware, because in the April report this time last month, the high estimate was over 2 million, and the actual number came in at a paltry 266,000, which left everyone bewildered. So the expectation is a significant move higher, yet it would still take many, many months to make, at a 645,000, let's say, to make up the 8 million shortfall that the U.S. non-farm payrolls have suffered during the pandemic. So that puts employment in perspective. Now, you were talking about inflation. The inflation readings for average hourly earnings in Friday's report are very minimal, at only 0.2% monthly consensus for a 1.2% annual gain. But this whole wages have been completely skewed by the elimination of the low-end, low-paying service jobs. So it's very, very difficult to read. And traditionally, of course, wage inflation was the key that the policymakers used to forecast what policy should be, under the assumption that never really prevailed over the last cycle, that tighter labor market would increase wages, which it never really did to a significant degree, and certainly never spilled over into overall inflation. But today we had the ISM. Today's Tuesday. We had the ISM, and we had prices paid at 88. Last month, in April, it was 89.6. But this is basically everyone in the sample is saying prices are higher now than they were a month ago. Now, the pass-through, we did a range of PMI reports today, and there's some pass-through appearing, but it's not to the same degree that the input costs are rising. But the manufacturers are getting a little bit of traction, and so that could prove inflationary. But I guess that still has to be seen. The employment index in the ISM report is worth noting. It came in at only 50.9 in May, despite all these astronomical readings, all near record highs or at record highs. Yet the samples can't find, on the U.S. side at least, are having troubles not only finding raw materials and getting them delivered in time, but also finding eligible employees who they can hire. So that's going to dampen, some of these issues, some of these inflationary issues, if these constraints limit production. So it's kind of up. Everything is kind of up in the air right now. It's interesting how much these manufacturing business surveys across the world are just all year long now, and even in Japan, which is having COVID issues and extended lockdowns, their samples are very similar to these results in the U.S. And also the optimism is very, very high. A little less high here because of all these constraints and uncertainty, whether or not what the outlook will really be, if they can really keep up with demand.
Yeah, I mean, it is a very similar situation, I think, we've had in Europe. As you mentioned, there's been a host of PMIs out over the course of the last, well, few hours, at least a couple of days as well. And the story coming out of Europe, where they're looking at the UK, where the manufacturing sector, according to the PMI, is enjoying its fastest growth on record, or the Eurozone, where it's a similar picture with, again, record growth coming through there as well. But it is very much the case, it seems, at the moment that it's how long it's going to take supply to really build up sufficiently to catch up with demand. And until we get that, it does seem as if these inflationary pressures are going to be around for some while. I guess from the central bank's point of view, their assumption is that that gap is going to steadily narrow to the extent that although we will get this increase in inflation over the next few months, it will be temporary. And once supply really gets back to normal again, those underlying pressures begin to ease a little bit. I guess we'll have to wait and see. I was guessing from the inflation side, I mean, it's over here. I should pick on the had the update for May, the flash May HICP report, as they call it, for the Eurozone. And it does really fit in with what the central banks are saying generally, in the sense that, yes, we did see a jump in inflation. So the headline rate for inflation for the Eurozone now, the annual rate, is at 2.0%. That was up from April's final 1.6%. A little bit stronger than the market consensus, and it's the highest outturn we've seen since October 2018. Now, just psychologically, that means that we've got Eurozone inflation finally above target, albeit not by much, but it's the first time we've seen that in what, best part of 31 months or so. However, and it's always a big however, but just looking at the way these core indices are going, and the main underlying measure is currently running at just 0.9%. So although that increased a couple of ticks today, that's its annual rate, it simply just reversed the drop we saw coming through in the previous month. So in other words, core inflation, to all intents and purposes, is still just moving sideways. Although this headline rate is continuing to accelerate, underlying pressures don't seem to be materializing at the moment.
But is that because the Eurozone has yet to really reopen? And I say that because on Friday we had the in the U.S. we had the personal income and outlays report, and the Fed's price gauges, which contain the Fed's price gauges, said this core reading rose 0.7% on a monthly basis, which kind of matches what the yearly basis was in Europe. And this annual rate is at 3%, which is, I don't know, that goes back, 20 or 30 years or even more. You don't normally see a 3% on the core annual rate, even though that's skewed because of last year's lockdown. But just looking at the monthly, and that followed a 0.4 in the prior month. And so if we get this gigantic acceleration underway in core prices in the U.S., now that could be tied, or is tied, to the reopening that is unfolding here in the U.S. And that is releasing, I guess, a burst of demand, and a lot of this demand is fed by all the stimulus that we have here in the U.S. Now, is there less demand, less stimulus for the European consumer than there is for the U.S.? I can't even describe what it is for the U.S. It's just unprecedented, I guess. I don't know what the word is, but is that the same level? And do you see a kind of upsurge in demand, or if and when reopenings really begin to take off like they are here, and like they apparently are in the UK?
Right. Which question to answer first? I guess go back to your comments on the inflation side. Is it because Europe hasn't fully reopened? I think that's a perfectly fair point, because clearly most of Europe is lagging a reasonable way behind what we've seen in the States. Because the UK is very different. And in theory, will be completely open from the back end of this month, subject to what happens to the latest COVID numbers. But even over here, the latest inflation numbers are for April, and the core rate there for the UK, that even then was just running at 1.3%. And we got a 2% target here, and we haven't been close to it for a long time now. The core rate's been below it for the best part of 2 years or so. So long before the COVID actually came in. So it's still seen, for whatever reason at this stage, although there are clearly pipeline pressures which are bubbling away, the wages market per se has yet to really react. Now, the big question, as you say, moving on to the bit about what happens when we do reopen, will we see a big increase in demand? Well, certainly most of the retailers retailers are indicating that's obviously what they're hoping for. But at the same time, some of the most recent figures, they've been okay, but they haven't necessarily been perhaps quite as strong as some people have been hoping. UK is a bit of an exception because by and large, almost all of the economic figures out of the UK have come in on the strong side of expectations of late. But generally speaking, I think it's probably a little bit too early to say whether or not we're going to see this big burst in consumption or we're not. It makes sense, I think, to assume that we probably will do, but it's certainly not guaranteed at this stage. And I think that's one reason why, certainly as far as the ECB is concerned, and of course we have the next meeting, where are we, on Thursday next week, I suspect they'll still be very much touting the line that, well, so far so good, the economy is doing better, but COVID is still around, even though it's coming down and the vaccination rates are going up. That's all very good, but the economy still needs a substantial amount of monetary accommodation if we're going to get the sort of sustainable recovery that they actually want. So I think big picture stuff is that the way the European economy in general is evolving, it's still some way behind where you are. The interesting bit will become, of course, if your inflation numbers remain relatively high or indeed go higher, and Europe starts moving in underlying terms in the same direction, then presume that's when some of these bond markets going to start running really scared.
That's an interesting point. Yeah.
In fact, it's interesting. I'm going to ask you. I mean, it's looking at since we go back, what, say 3 weeks, certainly 4 weeks ago. We're talking on his podcast about, well, everyone was talking about the shakeout in the bond markets and the way these yields are rising. But it does seem that despite the fact we've had relatively firm inflation numbers versus expectations, bond yields clearly have come down over the course of the last week or two, and it seems that markets are prepared to believe what the central banks are saying, i.e., yes, inflation's going up, but don't worry about it. It's only temporary. Is that the sense you get your side? I mean, why aren't yields higher now?
I guess aside from technical issues in the market itself, fundamentally that would suggest a faith in the transitory, temporary, one-time. The Federal Reserve in the U.S. case has certainly been, for months, has been preparing everyone for these numbers. So they aren't really a surprise, even though the monthly readings are on the high side and at the high end of the price on the high end of forecasts. But that is a reasonable assumption. But let's turn to the economies consensus divergence indexes, because in the U.S. it's basically flat. It had been very, very high, meaning that forecasters were underestimating results, and now they're just getting it pretty much dead on. But I've been noticing in the last couple of days that the indexes out of Europe seem to be very, very high, and I can't really put that together, but that would suggest then that the forecasters, that data, where they have the forecasters had a more lower, even though the European data doesn't seem that high, it's still beating expectations by an increasingly large degree. I mean, what's your take?
Yeah, I mean, it's a fair point, a good point. I think it's worth mentioning. I think what it kind of comes down to is the fact that we've had very bad COVID numbers during the first quarter coming out of Europe. So we had all the restrictions coming in, and as the numbers continue to deteriorate, increasingly the embedded expectation in financial markets was that these restrictions are going to be around for a long time. A number of podcasts have talked about Germany's extended its lockdown yet again, etc., etc. But in practice, what's happened after a very slow initial delivery of the vaccine rollout, which of course is one of Europe's biggest issues, what's happened is that the vaccine delivery has accelerated rapidly, and that's been reflected in a number of things. One, it's led to people being, I think, consumers and so on, businesses being more optimistic about the future. It's also led to an earlier than expected easing of some of the restrictions in a number of the big countries, and that's include Germany, certainly Spain, Italy as well. And that's meant that we've led to, although, as we said earlier, the reopening of the European economy is nothing like as far far down the road at the moment as it is on your side. Nonetheless, it has led, I think, to kind of a pickup in economic activity, which is, stronger than financial markets had been expecting. So, and that's been reflected in the ECDIs, which, as you mentioned, by and large, are pretty well in positive territory and reasonably comfortably in positive territory. They're not necessarily talking about a huge rebound in second quarter GDP growth, but they're certainly talking about a move, I think, back into positive numbers and potentially respectable numbers. And in the UK, where by and large, the COVID numbers have come down much faster than people anticipated. It's here where we've seen, almost all the numbers that markets have been forecasting have come in on the actuals coming on the strong side. So the UK ECDIs in particular have been holding up at very high levels for quite a while now.
You had a run of Swiss numbers today. Last week, the Swiss numbers were just through the roof. And tell us about, we have the first quarter GDP numbers are coming out. Some of them are first estimates, like Switzerland, and that's always hard for an investor to figure because it's so backward looking. But they are they're the fundamental core of what forecasters and policymakers are looking at. So fill us in.
Yeah, you mentioned Swiss first quarter GDP. It comes out sort of rather late compared to most of the other big countries. But we had that earlier on today. Just on a pure quarter-on-quarter basis, it showed a contraction of 0.5%. In fact, that was bang in line with what the market was anticipating, and indeed pretty well in line with what we saw for the Eurozone as well. However, I think, as you mentioned, it is very much historic and backward-looking now, and because of what's happening with the vaccine rollout and the COVID numbers, markets more than ever want to know what's happening at the moment. And to that extent, last week we had yet another record reading on the KOF leading economic index, which is one of the sort of the main barometers financial markets look at when they're trying to get some kind of handle on how the Swiss economy is going to perform over the next 3 to 6 months or so. That was its second consecutive record high. And by record highs, we're talking about huge increases here as well. So we're talking about numbers which aren't just unprecedented, but they're unprecedented by some considerable way. Mm-hmm. And today we had the PMI number for Switzerland, which I must say doesn't necessarily have the best track record with its correlation with GDP. But nonetheless, as we saw with the KOF, we had a record reading in April. We had a record reading in May as well. In fact, it's almost up at 70 now, which we're talking really strong numbers. So I think if you put it all together at the moment, the indications are that the Swiss economy could have a very good second quarter. And that, a bit like the rest of Europe, is because we've seen some of the planned relaxation of COVID restrictions being implemented earlier than anticipated because the COVID numbers have come down that much more quickly than was generally expected by the scientists and so on. So much of this hangs on, what's happening to COVID, whether we got it down, we can keep it down or not.
When's the next Swiss National Bank meeting, and what is this on, and how are they going to they have to, they always seem to be party poopers, right? They don't want strong data because it inflates raises demand for their currency. But what are they going to do with this?
Yeah, so it's a problem for Switzerland, as you mentioned. I mean, obviously they want strong numbers in the sense that they want to see a turnaround in the Swiss economy, in the same way that all governments and central banks want to see with their national economies. For Switzerland, of course, they've still got this big problem of how to manage inflation, in the sense that in Switzerland, we're talking about inflation numbers which simply just remain horribly low. So they've been trying to get inflation somewhere close to 2% for such a long time now. Actually, I can't remember. But we're currently running, as of the April rate, as I recall, it's still only running at 0.3%. The core rate was running at just 0%. These are year-on-year numbers. So the danger for Switzerland, of course, is that if we see a rebound in the real economy, and that encourages investors to start moving back into the Swiss franc again. It strengthens the franc, it reduces imported inflation, and they're really back to square one. I mean, inflation has been moving up over the course of the last few months, be it on the core terms or particularly headline, due to what's been going on with the oil prices. But yeah, it is still so low. They really need a period to allow it to keep going. So I think when we get to the next SMB meeting, and that's later on this month on June the 17th, they'll probably be almost stuck. I mean, they'd just be forced to not really do anything. They may make some noise with the fact that the economy perhaps is performing rather stronger than expected, but bottom line is inflation's still far too low. And of course, by the way, we don't want to see the Swiss franc strengthen. So in that context, they've got to do whatever they can to try and keep the Swiss franc where it is now.
Well, and they're doing this to protect their exports. But what are Swiss exports? Aren't they high-end goods that could have an insulation against against higher costs that customers want them no matter what?
Well, it's true. I mean, to be honest, if you look at performance of the Swiss exporting sector, then I think you might well be justified in saying, well, what is the Swiss National Bank on about? Exports out of Switzerland, obviously you've got the problems with COVID and everything else going at the moment. What's the underlying picture? But for a long time now, despite the fact that the SNB has been claiming that the Swiss franc is far overvalued, the Swiss exporters have actually continued to do extremely well. Now, that may well say something about, as you're intimating, that their exports aren't particularly price sensitive, so you can take relatively large swings in the exchange rate before you get any kind of real impact coming through in terms of the trade numbers. But I think for the Swiss National Bank now, the real worry is inflation. And they're just concerned that if we continue to see the Swiss franc, or I should say continue to, if we start to see the Swiss franc begin to move higher again, it is going to potentially put more downside pressure on inflation. And they've got this worry, like any other central bank, that if inflation stays negative for long enough, then inflationary expectations start going negative. And once you get people expecting prices to fall, and of course, all of a sudden you can get this complete halt to consumption because everyone expects whatever you want to buy is going to be cheaper next week. So that, I think, is the big issue for them, and why the Swiss franc has become such a major part of our Swiss monetary policy.
There seems some parallels between the Swiss franc and the Japanese yen. I wonder, and these are safe haven currencies, I wonder, as COVID, and hopefully it will continue to unravel, ease, I wonder if there'll be a flight out of these safe haven currencies. What do you think?
Yeah, I think it has become established, because looking at the way the Swiss franc has performed over the course, during the COVID crisis, initially when it struck, you had a big move into dollars, as you typically expect during times of global uncertainty. But Swiss franc, saw some inflows coming out of the Eurozone and to some extent, I think, out of sterling, but it didn't actually do that much. And during the course, so we've had these humpback swings and roundabouts with the COVID numbers. The Swiss franc hasn't really moved a great deal. And I think it's kind of a reflection of the fact that we're at this stage now whereby investors want to feel really comfortable that COVID has been dealt with, because they've been kind of caught out before when we had the first hump and the second wave, and the numbers started improving, and the hope, well, this is it now, COVID's been beaten, and then you get the best part of a third wave, or whatever you want to call it. Well, now most countries are getting the numbers where they want to be in terms of new cases and so on. The big question mark is are they going to stay down, or is it going to come back again? And if so, does that mean yet more lockdowns, etc., etc.? So I think in terms of the big picture, what you sort of suggest is it makes perfect sense. If we do get back to something more like a more normal world, whatever that really means, then yes, we should see some outflows from perhaps most of the the typical reserve currencies into what remain high yielding currencies. Because let's be honest, in this environment, investors really need to see higher interest rates to try and get some funds moving.
Well, I saw, here in the U.S., you don't get as many headlines concerns about the variants or anything like that. There doesn't seem to be a lot of guidance from public health officials or the government on what we can really expect here in the U.S. What COVID doing? It seems the vaccination seems to have hit a peak. So, and the cases are coming way down. But out of the UK, I saw a Cambridge professor coming out and warning, it's low, but it could go very, very high, very, very quickly. And I saw some of these other things coming out of Europe. What should investors do with these warnings? Go ahead.
I guess treat. You've got to take them serious because a lot of, certainly as far as the UK is concerned, these professors and scientific experts form part of the panel which are advising the government. So if you get a number of them all basically saying the same thing, then you've got to start believing that, well, okay, the government may need to start going down this route. And so as we record this podcast, I mean, at the moment, there is considerable doubt as to whether or not this magical June the 21st date over here, which is supposed to be when we finally get, the removal of all remaining social restrictions, whether or not that's actually going to continue to hold. There's a lot of suspicion that, and if you believe the professor you're talking about this morning, the recommendation from his was rather than June the 21st, just to be sure, because of these COVID variants, the safest thing would be to run the lockdown on for another 2, perhaps 3 weeks and see what the data are saying. So there's a lot of, again, it just comes down to uncertainty, I think. And the big worry still is that, although we talked before about the UK being further down the vaccination road than many other countries, but still a lot of UK people who have either only had 1 dose of the vaccine when they need to, or indeed not had any vaccination whatsoever. And so long as that gives a scope for the the COVID to actually be amongst the population, it gives scopes for more variants, and then the big worry that a variant turns up which the current vaccines simply can't cope with. So there's still an awful lot of uncertainty, I think, about out there about what's going to happen with regard to COVID and and ultimately the economy. Everyone's bullish about the economy because it's all, let's be optimistic, the world's going back to normal. There's always pent up demand. But if we were to see another wave of COVID, then, well, it's anybody's guess. And in fact, on that note, I suppose I should mention before we sort of round up and talk on for too long again, Canada, we had the Canadian GDP numbers a short while ago today. As we've said in the past, Canada's been one of those economies which has actually been performing pretty well, a bit like its US neighbour across the border. Well, GDP numbers for March, they have monthly numbers, that was up 1.1% on the month. And that meant for the first quarter GDP in Canada at a seasonally adjusted annualized rate, so to put it on US terms, it was up a very solid 5.6%, which is pretty respectable by anyone's standards, particularly when you think the Bank of Canada originally expected to post a fairly sizable contraction. So that's all good, and I guess it's going to encourage more talk about possible additional tapering from the Bank of Canada. Their next meeting is next week. Perhaps that's a bit too soon, but July certainly could be flagged. And if we were to get the labour employment report, we talked about the one out in the States, we also get the Canadian May labour market report on Friday as well. If that turns out to be much stronger than expected, and that's certainly going to fan the flames. However, these numbers are backward looking, and Canada was some way lagging behind the likes of the US and a lot of Europe in terms of the way the COVID numbers developed. So they introduced some, fairly heavy duty restrictions late March and early April time, which could put some downside risk on what's going to happen to the second quarter. So it may be that some of the growth we could have had in the second quarter really went into the first quarter, and vice versa. So it's the risk is that perhaps Canada's not really performing quite as well at the moment as the first quarter number might have intimated. That said, it should be noted that the vaccine rollout, and Canada again was one of those countries which started very slowly, has taken off like a rocket over the course of the last month or so. So it's kind of, the bad news is that, heavy restrictions were introduced in March and April. And indeed, I should mention that the flash call from the statistics people for April GDP is minus 0.8%, so not a good month. But this vaccine rollout has been so rapid that these should perhaps lead to better numbers coming out as far as May and June are concerned. It's going to be an interesting one to watch because there's quite a lot going on there. Mm-hmm. Okie dokie. Anything else we should mention? India, I suppose, just wrap off the central bank's side of it. We got an RBI meeting on Friday. Nothing is expected out of that. The good news from India is that the coronavirus cases appear to have topped a few weeks ago now, and they are coming down. However, they're coming down from, as I'm sure people are aware, horribly high levels. Mm-hmm. So it seems as if the RBI will very much be concentrating at the moment upon keeping the economy going, even though the inflation numbers are probably rather higher than they'd like to see.
We had the PMI manufacturing out of India today, and it was flat. It didn't go into contraction, but it slowed significantly. If that's the worst of it, that's not too bad.
No, yeah, good call. Quite right. I'll certainly be hoping that. Okie dokie. Well, I guess that's probably enough from us for today then. So, on behalf of Mark and myself, thanks as always for listening. Podcast will be back next week. And in the meantime, you know what I'm going to say. You can find all the key market moving data and events listed and analysed in Econoday's global economic calendar. We'll see you next time. Bye for now.